Welcome back. So now we're going to go over Appendix 2A, which is dealing with activity-based absorption costing. So let me go ahead and get this started here for you. So we're going to go over some key definitions and concepts now. So activity-based absorption costing assigns all manufacturing overhead costs to products using activity cost pools instead of plant-wide or departmental cost pools. So what this does is it's going to break it down more specifically in terms of what the activities are instead of just doing it on a plant-wide basis like we looked at previously in the other video. So first of all, an activity is an event that causes the consumption of overhead resources. And then the activity cost pool, therefore, the activity cost pool is a bucket in which costs are accumulated that relate to a single activity. So anything within that single activity is going to get divvied up into the activity cost pool. And then the activity measure is the allocation that is used as the denominator for an activity cost pool. And then the activity rate is going to be used to assign costs from an activity cost pool then to products. So now activity-based absorption costing differs from traditional absorption costing in two ways. So this differs from what we did previously in that the activity-based approach uses more cost pools than a traditional approach. And also the activity-based approach includes some batch level and product level activities and activity measures that do not relate to the volume of units produced, whereas a traditional approach relies exclusively on volume-related overhead allocation. So we see here, we're going to look at an example doing it two different ways. So first of all, we're going to do it based on the traditional approach, like what we did before. So Maxtar Industries provides the following information for the company as a whole and for its only two products, the premium and then also the standard smoker barbecue units. So they only make these two products, either a premium version or a standard version of the smoker barbecue. Now, if we assume that Maxtar's traditional cost system relies on one predetermined plant-wide overhead rate, and they would use direct labor hours as the allocation base, then its plant-wide overhead rate is $3.80 per direct labor hour would be computed as shown. So if you just divide the two, you're going to get that. Okay. Now, Maxtar's traditional cost system would report unit product costs as shown. So notice that the premium product assigns $7.60 of overhead cost per unit because it uses two direct labor hours times $3.80. And then the standard product assigns $5.70 because it only uses an hour and a half of direct labor hours. So an hour and a half times 380 is 570. Okay. And then we can calculate the amount of predetermined overhead per hour. So if we assume that under the traditional, okay, this is how they do it. So they take the 1,520,000. That is from the estimated overhead cost divided by how many direct labor hours, and that's how they get $3.80 for the amount, the predetermined amount for the overhead. Now, and then we see here how, again, that broken down. Okay. All right. So the Maxtar Industries, this would be the activity-based absorption costing or activity-based costing. So if they're going to do it, they're going to break it down. So they break it down based upon they still have 1,520,000 of manufacturing overhead costs that they assign, but they're going to break that down into each activity. So one would be the supporting direct labor hours. And then you also have the number of machine setups, you know, how that's set up, and then also parts administration and how you're going to do that. So you're going to break it down based upon each activity, and then that's how you're going to be able to do it. So the activity rate for each of the three activities is computed as shown. So we see here that for each activity, we can break it down and divide it out, and we get what the activity rate is for each activity. And we can use that then in order to figure out how we allocate our overhead. So for the premium product, we have $2 per direct labor hour, 100,000 hours, so that's $200,000, $600 per setup, and there's 600 setups, so that's 360,000. And then 1,200 per part type, there's 140 part types. So then that would be 168,000. And then we can do the same thing then for the standard product, breaking down exactly how many labor hours are used, how many setups there are, and how many different part types are used. All right. So the let's see. So the activity-based unit product cost for each product line is computed as shown. And then the manufacturing overhead per unit for both products is computed by taking the total overhead assigned to that product and then dividing it by the number of products that were produced to figure out the overhead per product. Now, notice that the unit product price of the standard unit decreased from $53.70 to $51.96, while the total cost of the premium unit increased from $71.60 to $78.56. The activity-based cost approach contains two non-volume related cost pools: setting up machines, which is a batch level activity, and parts administration, which is a product level activity. The activity-based approach assigns these costs to products in a way that shifts cost from the high volume product, which is the standard, to the low volume product, which is the premium. So now we're going to go over Appendix 2B, which is looking at the predetermined overhead rate and capacity. So let me go ahead and get that going here. So Appendix 2B, the predetermined overhead rate and capacity. So what we'll be doing is understanding the implications of basing the predetermined overhead rate on activity at capacity rather than at the estimated level of activity. So what that means is sometimes we base it upon uh, our capacity that we have in our manufacturing instead of the actual amount that we think that we're going to produce and what the impact of that is. And that's what we're looking at now. So predetermined overhead rate and capacity methods. One method that we have used bases the denominator on the volume of overhead rates on the estimated or budgeted amount of the allocation base for the upcoming period. A second method, often used for internal management purposes, bases the denominator value for overhead rates on the estimated total amount of allocation base at capacity. For the remainder of this appendix, we will make two assumptions. First is that all manufacturing overhead costs are fixed, and that the estimated or budgeted fixed manufacturing overhead at the beginning of the period equals the actual fixed manufacturing overhead at the end of the period. So traditional absorption costing. There are two significant problems with using the traditional absorption approach from a managerial accounting position. First, if predetermined overhead rates are based on budgeted activity and overhead includes significant fixed costs, then the unit product costs will fluctuate depending on the budgeted level of activity for that period. So what they're saying is, if based upon if the amount of units changes, then the cost is going to change, or the level of activity changes, the costs are going to change. Now, the second limitation of the absorption approach is that it charges products for resources that they did not use. When the fixed costs of capacity are spread over estimated activity, the units that are produced must shoulder the costs of any unused capacity. So they're saying if there's more capacity, we're not, they are absorption costing is they're charging products for resources that they didn't use if there's excess capacity. So capacity-based overhead rates. The limitations of traditional absorption costing can be overcome by using estimated total amount of the allocation basic capacity in the denominator of the predetermined overhead rate calculation rather than the estimated total units in the allocation base in the denominator. So we'll look here. So capacity-based overhead rates calculations. Prahad Corporation manufactures DVDs and leases a piece of equipment for $180,000 per year that can produce a new DVD every 10 seconds. If ran at full capacity, the machine can produce 900 DVDs per year. However, the company estimates that 600 DVDs will be produced and sold next year. So if we base it on a number of units that we think that we're going to produce and sell, 180,000 is the fixed price for this lease for this machine, divided by 600,000 DVDs times 10 seconds per DVD is going to be 3 cents per second. And then if we use the predetermined overhead rate at capacity, we have 180,000 divided by 900,000 DVDs times 10 DVDs a second, brings it down to 2 cents per second. So the cost of unused capacity, part one. So we have the predetermined overhead rate, if used on capacity, is the 2 cents per second. And then we can calculate the cost of the unused capacity using the following formula. So if we take our allocation base at capacity, which is 9 million, subtract the actual amount of the allocation base, or what we actually used, which is 6 million, times 2 cents is the predetermined overhead rate, or the cost of the unused capacity is $60,000. So they could produce more, they're just not. And we're trying to figure out what the cost is for them having capacity in this machine, but then not utilizing it. So the cost of the unused capacity would be reported on the internal use income statement as an other expense, just like selling or administrative expense. So they're paying for this, but obviously they're not utilizing it. So managing the cost of unused capacity, rather than treating it as a product cost, as is done on the absorption approach, the capacity-based approach would treat this cost as a product expense, as a period expense that would be reported below the gross margin. Now, the need to efficiently manage capacity is then highlighted for the company's managers. And so, because again, this is a cost, or it's really an opportunity cost. They have this machine, it's able to produce it, but they're just not utilizing it to the fullest capacity. And that's what we're trying to figure out, is how much spare capacity do we have that we're underutilizing. And so with this, and we now have a number with it, what they can do then is they can seek new business opportunities to consume that capacity. So maybe they take on another client that would then fulfill that, and they could be able to produce that. Or they could find out ways to cut costs, or shrinking the amount of available capacity out to work in progress, finished goods, and or cost of goods sold. So they can work with that. Maybe because this machine, it's able to do that many, maybe at the end of that lease, because they're probably stuck in it, they might be able to lease a machine that, instead of doing 900,000 DVDs, maybe does closer to the 600,000 that they actually need. So if that actually is all that they're going to be end up selling and end up producing, maybe they could get a smaller machine that would be more, the cost would work better for them. So they could also work that out to understand that, so they can make changes in it to utilize that. So these were just a couple of different ways you can look at it in order to help you to be able to make some different types of business decisions.